Welcome, everyone, to the Gold Talk Show right here on YouTube.
Well, great to be here.
We're glad you could join us. Today, we're pushing aside the local noise, you could say, and really digging into the big forces, the global forces shaping the gold market.
That's right. We're looking at the international picture.
Exactly. You sent over some fascinating material about what really moves the needle on the world gold price, and, well, that's our mission today. Unpack it all for you.
Yeah, get to the core of it.
We want to pull out the key insights, give you a really clear understanding of the major players moving gold prices worldwide.
And gold's role is, well, it's always been pretty critical globally, hasn't it? Historically, it's that key safe haven.
Right, the go-to in uncertain times.
Exactly. A store of value when the economies get shaky or inflation picks up.
Yeah.
And it's not just for, individuals. It diversifies big investment portfolios, stocks, real estate. Gold fits in there.
Plus, it's liquid, right?
Right.
Relatively easy to buy and sell compared to, say, property.
Very liquid. And of course, nations hold it in their foreign exchange reserves. It's a hedge against their own currency losing value.
Okay, so the material you sent talks about these teams driving the price. That sounds a bit dramatic. What does that actually mean in financial terms?
Yeah, teams is maybe a casual way to put it. Basically, we're talking about huge investment funds, massive pools of capital.
Ah, okay. Big money movers.
Precisely. Their decisions, buying tons of gold, selling tons of gold, that's what can seriously impact the global price. They have that kind of clout.
Got it. So let's break down these teams. The first category highlighted was gold ETFs, exchange-traded funds. Tell us about their influence.
Right. So gold ETFs, they're investment funds you can buy and sell on stock exchanges, just like a share in Apple or something.
Okay, accessible.
Yeah. And the biggest one globally is SPDR Gold Shares. Its ticker symbol is GLD.
GLD. Heard of it. How big are we talking?
We're talking huge. Currently, its assets under management are around $64.2 billion.
Wow. 64.2 billion. That's hard to even picture. What does that mean in actual gold?
Well, as of Q2 2025, that translated to about 178 tons of physical gold.
Over 1,000 tons. Held by one fund.
Yep. GLD works by issuing shares to investors, taking that capital, and then buying real physical gold bars. It's the dominant player, no question, holds something like 30% of the entire global gold ETF market.
30% market share. And I think the notes mentioned a slightly more recent number for their holdings.
Yes, that's right. By February 2025, the figure was around 900.53 tons. They actually sold a little bit recently, bringing it down closer to 905 tons. Probably some profit taking.
Still over 900 tons. How does that stack up against, say, what countries hold?
It's significant. Even at 905 tons, that's about 6.8% of all the gold held by all the central banks in the world.
Okay, 6.8%. That really does put their potential influence into perspective.
Yeah.
So how does a fund holding that much actually move the market?
Right, this is the key part. It's estimated that just a 1% change in GLD's gold holdings, up or down, can shift global gold prices by about 0.3% to 0.5%.
Just 1% change has that ripple effect. How?
Well, think about it. A 1% change might mean they're buying or selling, say, 9 tons of gold. That's a big order. It hits the futures markets, influences sentiment, and through arbitrage, that affects the price for immediate delivery.
Ah, okay. So their trading activity directly translates into price movements. That recent selling you mentioned was likely profit-taking.
Most likely, yeah. Investors who bought lower wanting to cash in. GLD itself is managed by global advisors, and they charge a 0.4% annual management fee that attracts big players, institutions, wealthy individuals, mostly from the U.S. and Europe, but Asia too sometimes.
Okay, so GLD is clearly number one. Who's the runner-up in the ETF world?
The second largest is the iShares Gold Trust. Its ticker is IAU.
IAU. And their size?
They manage around $32.7 billion in assets, still a very substantial amount.
Definitely not small change. And the gold they hold?
IAU holds roughly 541 tons of physical gold.
So between GLD and IAU, what does that add up to?
That's the really striking thing. Together, just those two ETFs, GLD and IAU, they count for about 70% of the entire global gold ETF market.
70%. Just two funds. That's some serious concentration. What about their costs? Are they expensive to invest in?
Actually, no. Their management fees are pretty low, relatively speaking, somewhere between 0.25% and 0.4% per year.
That seems reasonable.
It is. And that low cost makes them a really attractive way for investors, big and small, to get exposure to gold prices without actually having to, buy gold bars, find a vault, get insurance. all that hassle.
Right. Now, someone listening might be thinking, okay, 1,000 tons, 500 tons. How does that compare to what countries like the US or China hold? They have huge reserves, don't they?
They do, absolutely. But that's a crucial difference. National reserves held by central banks are generally for long-term strategic purposes, financial stability, that sort of thing. They mostly just sit there.
So they're not actively trading it day to day.
Not usually, no. Whereas these ETFs, GLD and IAU, they're actively trading, buying and selling based on investor demand, market conditions.
So it's that activity, the constant buying and selling by these massive ETFs, that gives them such a big impact on short-term price swings.
Exactly. That's the key driver. When one of these big ETFs decides to sell off a chunk of its gold, maybe because investors are pulling money out, that gold hits the market.
And pushes prices down.
Right. It can impact both the spot market for immediate delivery and the futures markets pretty quickly, leading to those percentage drops we talked about. Their frequent trading is really why they influence short-term volatility so much.
Okay, that makes sense. Now, the source material also mentioned another category, gold trust funds. How are they different from ETFs?
Gold trusts are another way to invest, but they tend to operate on a slightly smaller scale compared to the big ETFs. Globally, they manage maybe around $12 to $13 billion in total.
Still significant, but not quite ETF levels. Any other differences?
Interestingly, yeah, their management fees are often even lower. We're talking around 0.17% on average.
Wow, even cheaper. So what's their main purpose then? Who uses them?
Well, their function is pretty similar in principle. They let investors put their money into gold without having to handle the physical metal themselves. You entrust your savings to the fund, they buy and store the gold for you.
So convenience again, avoiding the hassle of physical ownership.
Exactly. It's about outsourcing the buying and storing.
Are there any major players in the gold trust space? Examples.
Yeah, the notes mentioned Granite Shares Gold Trust, ticker AAU. They manage about $8.5 billion right now and hold around 139 tons of gold.
And where do they keep it?
Their gold is stored securely in vaults, approved by the LBMA, that's the London Bullion Market Association. They're the sort of the governing body for the big wholesale gold market in London.
Right, the LBMA standard. Any others?
Another one mentioned was simply called Gold Trust, ticker BAR. They manage about $10.28 billion.
With these kinds of funds where you don't physically see the gold, trust and transparency must be absolutely critical, right?
Oh, completely. And the source material did highlight this. Big auditing firms like PwC, KPMG, the major global accountants, they regularly audit these funds.
Checking the books, verifying the gold is actually there.
Exactly. They verify the holdings, check the transactions. That independent oversight is essential for giving investors confidence that their money is actually backed by real gold stored securely. It builds trust.
Makes sense. Okay, so we've got ETFs, we've got trusts. The third category I mentioned was gold mining funds. Now, this sounds like a different approach altogether.
It is, yeah. A completely different angle. Instead of investing directly in the physical metal, these funds invest in the companies that, well, dig the gold out of the ground, the miners.
So you're buying shares in mining companies, not gold itself.
Precisely. Investing in companies involved in exploration, development, extraction, the whole mining process.
And did the source point out a major fund in this area?
It did. The VanEck Gold Miners ETF, ticker GDX, it's a big one, managing around $18.6 billion in assets.
$18.6 billion invested just in mining companies. Wow. Does it spread the risk?
Yes, it invests across a portfolio. Currently about 54 different gold mining companies.
Diversified within the sector. Can you give us an idea of who they invest in, like the big names?
Sure. Their top holdings are the major global producers. Companies like Newmont, that's about 15.8% of the fund. Then Barrick Gold, around 13.2%. And Agnico Eagle Mines at about 10.5%. The giants of the industry.
Right, the household names in gold mining. And how have these mining funds been doing lately, performance-wise?
Pretty strongly, actually, reflecting the rise in gold prices. The VanEck Fund, GDX, reportedly had a return of 38.2% in 2024.
38%. That's impressive.
And the estimate for 2025 was even higher, somewhere in the 60% to 70% range. Of course, that reflects the big jump in gold prices we've seen.
Okay, so potentially much higher returns than just holding gold. But I'm guessing there's a catch, more risk involved.
Exactly. That's the trade-off. Gold mining stocks, and therefore funds like GDX, tend to be much more volatile than the gold price itself. They have leverage.
Leverage? How so?
Well, a mining company's profitability is highly sensitive to the gold price. A small increase in the gold price can mean a big jump in their profits, and vice versa. So their stock prices tend to move more dramatically than gold. The material suggested it's often around 2.3 times the movement of gold.
2.3 times. So if gold goes up 10%, the mining fund might go up 23%. But if gold drops,
It could drop 23%. Exactly.
yeah.
Higher potential gains, but definitely higher potential losses, too. It's an indirect way to play the gold price, through the companies pulling it out of the earth. Even Warren Buffett's Berkshire Hathaway, interestingly, took a stake in a mining company in 2023, early 2024.
Huh, interesting. So even the big value investors see potential there sometimes. Okay, let's circle back quickly to the biggest player we discussed, SPDR Gold Shares, GLD, just to reinforce its scale. Established 2004, ticker GLD.
Right. And its net asset value, beginning of 2025, was around $88 billion. Huge number. As you said, that gives it that dominant 30% market share in the global gold ETF space.
And the key holding figure again.
As of February 2025, it was that 907.53 tons, which again is about 6.8% of all the gold held by central banks globally. It just highlights its sheer size and potential market influence.
And that trading impact is really worth hammering home, isn't it?
Absolutely. That estimate of 1% change in their holdings, maybe 9 tons of gold, potentially causing a 0.3% to 0.5% price move, that's significant.
And the source mentioned they were recently selling, taking profits, a real-world example right there.
Exactly. It shows how their actions, buying or selling based on investor flows and market views, directly impact prices in a way that, the big static reserves of central banks generally don't day to day.
Okay. Now let's revisit number 2 as well, the iShares Gold Trust, IAU. What other details did the material provide on them?
So IAU, second place, around $41.7 billion in assets as of February 2025. That gives it about a 14.3% slice of the global gold ETF market.
Still a major player. Any growth noted?
Yeah, it actually saw pretty strong growth, 18.2% compared to the same time in 2024, and it trades on the NYSE Arca exchange, one of the big U.S. exchanges.
Right. And their physical gold holdings? Any recent trends there?
They held roughly 517.6 tons of physical gold. That's about 16.6 million ounces. And interestingly, unlike GLD's recent small sale, IAU had actually increased its holdings quite a bit.
Oh, they were buying.
Yes, they added about 42.3 tons between the end of Q4 2024 and Q1 2025. That's a 12% increase in just one quarter.
A 12% jump. That's significant buying.
It is. And while their share of central bank reserves is smaller, about 3.7%, the report highlighted that IAU had been consistently net buying gold for the previous 6 quarters straight.
6 quarters, so a year and a half of continuous net buying from the second biggest player.
Exactly. And GLD also had a similar buying streak before their recent profit-taking. So when you see the top 2 players representing 70% of the market, consistently absorbing large amounts of gold over an extended period.
That puts serious upward pressure on the price, right?
It strongly suggests it, yes. It points towards underlying macroeconomic drivers. Maybe worries about inflation, maybe money supply increases, pushing major investors toward gold via these big ETFs. That buying pressure is likely a big factor in why gold prices have been rising.
It paints a picture of huge demand from these funds. Now, handling all that physical gold, hundreds, even thousands of tons, it does raise the question of security. Where is it all kept?
Yeah, that's obviously paramount. You can't just, keep it in the office basement.
Yeah, probably not.
The physical gold bars held by these funds are typically stored in extremely high security vaults. Often these are operated by major financial institutions. The source mentioned JP Morgan's vaults in London as an example.
Okay, Fort Knox-style security.
Pretty much. And on top of that, you have those top-tier auditing firms regularly verifying the inventory, plus comprehensive insurance policies. It's all designed to ensure transparency and, crucially, the security of those assets. That reassures investors their gold is safe and accounted for.
Right, the trust factor again. It also seems like the cost of investing through these funds varies internationally compared to local options.
It can, yes.
Yeah.
Those management fees we talked about for the big international ETFs and trusts, 0.17% to 0.4% per year, are generally quite low.
Lower than what, potentially?
Well, in some local markets, the main cost might not be a management fee,
Mm.
but the difference between the price you buy physical gold at and the price you can immediately sell it back for. That spread can sometimes be significantly wider, effectively a higher cost, than these low annual fees.
Ah, so the cost efficiency of these large international funds is another reason for their popularity globally.
Definitely. It contributes to their appeal for investors all over the world.
So it sounds like for a lot of people, especially in developed countries, investing via these funds is the main way they engage with gold, more so than buying coins or bars.
That's often the case, yes. Many individuals prefer the convenience, They choose to invest in gold through funds like GLD or IAU rather than dealing with the logistics of buying, storing, and insuring physical gold themselves.
It lets them benefit from gold price movements without the physical hassle.
Exactly. They get the price exposure without needing a safe deposit box or a home vault.
The source material also touched on a third significant fund, didn't it? One with a specific focus.
Yes. A slightly smaller player, but notable. It holds around 338.5 tons of gold. Its key feature was an emphasis on transparency and, interestingly, the source of its gold.
The source. How so?
Apparently, it makes a point of sourcing its gold only from mines that adhere to specific high standards for environmental protection and labor practices.
Oh, like ethical sourcing.
Kinda, yeah. Mentioned mines in places like Canada, Australia, Ghana as meeting their criteria. It also reported a strong return in 2025, 44.02%, and had plans to grow its holdings and even diversify into other precious metals.
Interesting angle. And just briefly, were there mentions of the fourth and fifth largest players, just to round out the picture?
Yeah, very quickly. There was an ETF managed by Goldman Sachs, about $18.7 billion AUM, roughly 6.5% market share. Notably, it uses futures contracts as part of its strategy. Its return was mentioned as 4.38%.
Okay, Goldman Sachs using futures. And another one.
And then a lower cost option, apparently with links to BlackRock, the giant asset manager. This one managed around $16.8 billion, had a very low fee of 0.17%, held 235 tons of gold. It showed strong growth, 27.6%, and high returns in 2025, 42.98%, likely boosted by using leverage.
Leverage again, and BlackRock involved.
Yes, BlackRock apparently has a significant stake, and obviously BlackRock itself manages trillions globally, so their influence is immense across markets.
Right, so putting it all together, it's crystal clear, isn't it? The global gold market isn't just moved by headlines or small local trades. It's heavily influenced, maybe even dominated, by these enormous funds.
Absolutely. We're talking about players who buy and sell gold by the ton, collectively holding amounts comparable to major central banks.
Understanding their actions, their buying and selling trends, their motivations, like seeking safe havens or reacting to inflation, that really gives you a much, much clearer picture than just watching the day-to-day price flicker, right?
Precisely.
Yeah.
If you want to understand the fundamental forces driving global gold prices, you really need to keep an eye on what these big funds, the ETFs, the trusts, even the mining funds are doing. Their flows and holdings are key indicators.
Well, this has been incredibly insightful, a real deep dive into who's actually pulling the levers in the global gold market.
Glad we can shed some light on it.
Yeah.
It's a complex world, but understanding these major players is crucial.
We really hope this discussion has given you, our viewers, some valuable insights into how the world gold market operates.
Yeah, hopefully it cuts through some of the noise.
If you found this information useful, please do give us a like, share this video, and definitely subscribe to the Gold Talk Show right here on YouTube.
That way, you won't miss our future discussions as we continue to track the factors shaping the gold market.
Absolutely. Stay tuned for our next deep dive. Thanks for watching.